Well, good afternoon, ladies and gentlemen, and welcome to the session on business valuations. I'll try and make it as interesting as I can. Just for interest's sake, put your hands up if you have done valuations or you know what valuations are, so I can, okay. Well, who wants to come up and present? Well, that's very good. Valuations in all streams of accounting are becoming more and more important, especially in the area of tax. And as we'll get to see, every aspect of tax requires a valuation. And valuations generally, I've been in valuations, as you heard from Mr. Good, Bad or Ugly, I'm not sure, for a good number of years, and I've seen that it is very rewarding in that the valuations can be required for compliance purposes as well as for tax planning. And it gives you a great level of pleasure if you're helping your client avoid or minimise, as we say, minimise their tax. Put your hand up if you're from the ATO, or is anyone from the ATO? I'll just be careful if there is. Anyway, so I'm a private practitioner, and PPB is on the panel of the ATO, and we also work against the ATO. So we have a good insight as to what the ATO is looking for and what is on their radar. So I'll try and share a few of those things with you today. So getting into what we're going to cover, just some of the tips and tricks that I've learned along the way. Valuations is a very comprehensive and very broad topic with a lot of depth. So what I've decided to do today is give you a good pack to take away with you if you've got the slides in front of you. Do you have the slides? Enough to make yourselves a little bit dangerous in terms of doing valuations, but it's a good reference point for you to take away. So I'll give you, as I said, the tips and tricks, and then we'll run through some of the areas where valuations are required for tax, and you'll be surprised that valuations are required for many aspects of tax, going from income tax to super to capital gains tax, GST and the like. And then we'll cover off on what the ATO is thinking about and what guidance the ATO gives to valuers and other accountants out there. In terms of a valuations practitioner, I get great pleasure in working with tax advisors. We generally get the best outcome for our clients when we work very closely with tax advisors, and we can minimise tax if we are proactive. And there's a lot of areas of tax where, as an accountant or a tax advisor, you can assist your client by looking forward and planning and helping them save tax. It's very disheartening when we're called at the last minute to try and sort out a problem. We always sort out a problem, that's what we tend to do, get the best outcome for our client. But it is easier if we have a bit of time and we work with the tax planners and the accountants to try and prepare for an event that might cause or introduce a taxing event sometime in the future. So on to the concept of value. You might think this is a bit of a no-brainer, but market value is a very important determination of tax in a lot of the areas. It, as I said, is for tax planning and for calculating the amount of tax. The operative word on that slide is market value. You'll probably think that, market value, that's a no-brainer, but just wait and see. In terms of tax valuations, they're needed, as I said, in a lot of areas. For trading, calculating the value of your trading stock in order to work out what your tax deductions are, for purchase price allocation together with tax consolidation, for debt forgiveness. That's a big area in terms of what the ATO is looking at when companies forgive debt. Tax consolidation, value shifting. That's, as you've seen in the press, the ATO is looking very closely at internationals where they are profit shifting and shifting value overseas where they're paying tax in lower tax jurisdictions. Employee share schemes, that's where we come in and try and help and minimise the tax, and working out the value of the options or the performance rights that are offered to shareholders, and there we work with a tax advisor to try and minimise the value of the share, so much so that they pay minimum tax from the employee's perspective. And thin capitalisation, that's also a very growing area. We've seen that the ATO is looking very closely at accounting financial statements, and we had a client who was in the pharmaceutical area, and they made an acquisition and they brought on their balance sheet a huge amount of value of brands and goodwill. then the ATO, and the company didn't start travelling very well, and started recording losses, and the ATO was smart enough to watch the financial statements which they'd put out and lodged with ASIC. And the company had been given some loans from their overseas parent, and they had a thin cap issue arising, and the ATO was watching this from the accounting perspective as they were writing down impairing their assets on their balance sheet. And the ATO made an inquiry, and as I said, this is where the ATO is looking broader and wider, and watching not necessarily only what the taxpayers are providing and the accountants are providing the tax authorities, but also what's happening in the wider industry in terms of accounting. So market value principles. If anyone's been to the ATO website, there is something called the ATO guidelines on the website, and it generally gives you a good guidance if you're a valuer. Generally, it was also set up for property, plant and equipment valuers, but over time, the ATO has been adjusting and amending these guidelines for business valuers. It tells you exactly what sort of methodology to apply in what circumstance. It also gives you the definition of value, and I'll get into the definition of value shortly, and it provides guidance as to what should be included in a market valuation report, as well as the reasonable grounds in terms of allocating value when there's a tax consolidation exercise or allocation of value when an acquisition has occurred. And it also sets out the ATO's approach in giving ATO rulings or tax rulings. So I encourage anyone who is giving tax advice and does touch on valuations to have a look at the ATO guidelines. In there, they have a matrix which the ATO uses to test and look at any lodgements of tax and whether it's a high risk. So in terms of high risk, if there's huge dollars in terms of tax payable or losses, or the report is not comprehensive or prepared by an internal accountant or the company's own accountant, all these things are red flags. So on this risk matrix from low to high, the ATO has identified certain aspects which causes it to rank a valuation or a tax event as a high risk or low risk. And generally in the high risk, the ATO will come along and ask to investigate. That is generally quite complicated because they will either appoint their own valuer and charge the taxpayer for the convenience of getting their own value the taxpayer's business or whatever the aspect of the subject of the tax is. So in terms of market value guidelines, the definition of market value is very specific, and it's not defined in the Tax Act. And again, I point you to the ATO guidelines. There they have covered off the different definitions of value and the various sources of the definition of value from the international valuation standards, the accounting standards, and case law. From a tax perspective, the focus is on knowledgeable and willing and not anxious buyer or seller, and focuses on highest and best use. Both parties must be fully informed, and is the sell price of the asset equal to the market value. The emphasis from market value from the ATO's perspective is market. So they will always lean towards the evidence of a sales price out in the market. So bear that in mind. We had a client who had a property alongside a development. It was a residential development, and the taxpayer was knocked on the door by the developer next door and was offered a huge price, 16 million for his block of land, because the developer wanted to further develop his residential property on the taxpayer's property. The taxpayer paid maybe 3 or 4 million for the property when he bought it probably 5-6 years ago, and then the ATO lodged a capital gains lodgement or assessment on the taxpayer for the 16 odd million. We were able to come and successfully challenge and say that the market value was about 4 million or 5 million, and not the sales price. And the operative word, as I said earlier, was focusing on market value. We went and had a look at different properties around the place which are similar, and we found that the developer who had paid that 16 odd million had paid special value, and special value is not market value. So there's a few tricks. As I said, the ATO is always focusing on sales price. If it's a higher sales price, it's in their benefit. So always watch out for gaps in the market and in the law, so we can assist the taxpayer minimise their tax. I don't have to go on to say to you that price is not value and value is not price. Value is an objective, value is subjective and price is objective. But the funny thing is that price becomes value over time. So when we look at comparable companies and get data in the market, we just generally look at past sales prices to give us an indication of value. So it's a bit of a funny misnomer. And the price is value, and value is not price. As I mentioned earlier, there's many different definitions of value, and this is a bit mind-boggling, as I said, that there's the various sources of definitions of value, and they're all very slightly different. So you have to be careful of the definition that you use in a valuation report that you levy to the tax authorities. There was an incident in the Kingara case where a Big Four accounting firm had valued a minority stake of some convertible preference shares, and the parties couldn't agree. And when you comb through the report, the valuer had, in their definitions of value, in their general approach to the valuation, had included the whole definition of market value. But throughout the report, it actually concluded on fair value. That unfortunately, when the parties couldn't agree, they were sent to court. And when the judge has to make a decision on which way to go, the judge actually threw the whole valuation out, because the valuer had not done what was instructed, and it wasn't market value. So a couple of lessons from that: make sure that you always apply the right definition of value, and secondly, anything can happen if it goes to court and the judge makes up its mind. So we've analysed quite a few court cases, and they're all very different in terms of the outcomes, not always predictable. So you go and play lotto if your case goes to court. So as I said, the definition of market value, going back to 1907 in the Spencer versus Commonwealth of Australia case. So some of the key concepts coming out of that case are still used and are very relevant today in terms of willing and not anxious vendor and purchaser, acting at arm's length, parties being fully informed in a hypothetical situation. So that's quite important, the hypothetical situation. So when we look at a business, what I mean by hypothetical is if the business has incurred expenses which are unusual or one-off or not at arm's length, we generally normalise those expenses as if the business was operating in a normal environment. And that's what I mean by hypothetical. So if there's any potential purchaser or seller out there, the business is operating on a normal basis, and the purchaser would expect to be operating that way, and not having huge, massive profits or losses. We had a situation where we were valuing an ingredients business not too long ago, and this ingredients business was a middleman or a trader in such ingredients for craft and for baker's delight and the like, and they were starting to get into probiotics, and probiotics is quite a fad at the moment, and everyone is after probiotics, and the business started to take off. So this business had been operating for about 20 years and generally had turnover about 10 mil and EBIT of about 3 off and on over the period. And then when probiotics started taking off, turnover increased to about 13, 14 million, and EBIT went the same way. But the ingredients users, like the crafts and the baker's delight, started getting smart and cutting out the middleman. and severing the contracts with the ingredients trader, and profits and the like just dropped. So that was quite confusing to look at those financial statements and the history and the trend of performance. So do you normalise and take out the probiotics from the scratch, even though it had been trading with probiotics leading up from maybe a couple of 100,000 in the first year, 500,000 the second year, and about 1.5 million in the third year? Do you normalise, or do you say this is the way to go? So I took a bit of research to see what was happening in other companies out there, what was happening in terms of probiotics. So what we decided to do was normalise, and we found that there were fads going back through the trading history of this company. There were fads previous in probably 4 or 5 years ago. So the company had its core business of core ingredients, but jumped in and out of new ingredients from time to time. That was just part of its business. So the meaning of market value has important concepts, as I said, highest and best use. And this is if the wind was blowing, ATO would be leading always towards highest and best use. So for example, if there was a property which was just being operated as a car park in the middle of the CBD, say, the ATO, and it was involved in a transaction, the ATO would have a look at this and say, highest and best use is like the buildings around it. And it's a big challenge for the valuer like ourselves to put up another case to defend and try and minimise the tax. Arm's length is also a very important concept. Even doing a transaction at arm's length is quite onerous. The ATO expects there to be legal contracts between the two parties that are dealing, and even then, they're sometimes not happy that what the transaction that is presented to them is arm's length. So there's a lot of things that they have to do, or we have to do as valuers, to prove that a transaction is done at arm's length. And generally what we do is we go and have a look in the market for comparable companies that are similar, and having a look at what their profit margins are, and back solving to see what sort of margins our company has compared to those comparable companies. We had a situation where we had a manganese operator, and the State Revenue Office in the Northern Territory was thinking, the manganese that was starting to take off with the Chinese boom, rubbed their hands and tried to levy as much tax on this poor miner as they could. But manganese, as you know, the mining boom in Australia was up pretty quick and came down with a thump. And as with a lot of mining companies, this company had a marketing hub in Singapore, where there was probably 2 or 3 traders trying to sell the manganese into the Chinese market. And it was quite complicated because the Northern Territory, the port was not in the Northern Territories, it was in WA. So the taxing point was at the mine gate, not when the manganese got onto the ship. So the ATO or the State Revenue Office had tried to levy tax on this manganese producer from the time it got onto the ship, and obviously there's a lot of travel and a lot of processing that happens between the mine gate and it going free on board or COB on the ship. So we had to back solve and do a lot of calculations. And pleased to say that the State Revenue Office saw sense and accepted our calculations. So arm's length is quite complicated, and tread with care if you go in that direction. Timing of valuations is critical. Obviously, the logical time to do a valuation is right just before or just after the taxing event. That's the ideal time for a valuation to be undertaken if it's required. However, we have had situations where a couple of years have gone by and the ATO takes a while to process certain things and have a look at certain documentation and transactions. We can come back later, and we've often had the case where we've had a call, hurry up, we did a transaction 5 years ago. Can you come and do a valuation 5 years ago? It is challenging, but we can do it. it unfortunately doesn't have as much weight as if the valuation was undertaken at the time the transaction occurred. In terms of valuation approaches and methods, as the HO guidelines say, there are three approaches. There's the cost approach, the market approach, and the income approach. This is important because the approach you select and the methodology you select have to be appropriate for the subject matter that you are valuing. If you use the inappropriate method, you will get an inappropriate outcome. So under the income approach is generally everything that's relating to income. Market is everything related to benchmarking, so comparable transactions, and the cost approach is based on working from the bottom up on a cost basis. The cost approach will always give you the minimum value, and the income approach and the market approach will give you some value which is higher than cost. And the differential between cost and the value is what we call either the intangible assets or the goodwill. The income approach is a discounted cash flow, so if you're a geek out there in terms of financial modelling, net present value and all that kind of stuff, that's the income approach with a DCF is generally useful for mines where they have life of mines, infrastructure assets where they have got cash flows for some 25 years. Infrastructure assets I mean by toll roads and wind farms and power stations and the like, or startup businesses. I wouldn't use a DCF for a business which you can predict the profits from one year to the next. Generally, those businesses grow at a predictable rate, so we would use a market approach with some kind of multiple. And when you do a valuation, it's always important to apply one or two cross-check methodologies or one or two cross-check rules of thumb. And if you don't get the same answer, something's gone wrong along the way, and go back and have another look. So the difference between enterprise value and equity value, this often gets people unstuck. So enterprise value is you can look at it two ways. It's the value of your debt and the value of your equity. So what part of the business has been funded by debt providers and what has been funded by equity. By debt funders, I mean long-term loans, convertible notes, mezzanine debt, and those kind of things. And equity is generally ordinary equity. If you've got convertible preference shares, then generally you split. From an accounting perspective, you split that between an equity instrument and a debt instrument because it's got both kinds of characteristics. The equity value is really just the equity of the business. So another way to look at it is if you look at the whole balance sheet, and you're all accountants out there, if you look at your total assets, that is generally your enterprise value, and if you look at your net assets, which agrees to your owner's equity, that is your equity value. So you can see that you use your whole business balance sheet to calculate the value of the enterprise, and that's important when you come to do a discounted cash flow or you do a capitalisation of earnings methodology, just understanding which part of your earnings you're using to calculate either an enterprise value or equity value. Another area where valuers or accountants get unstuck. So discounted cash flow, as I mentioned, great for startups, great for mines where you've got mine plans and you can map out what your production is and what you expect in terms of your cash flows, and as well as infrastructure assets. So it's a time value of money. Difficulties also in calculating what the discount rate is. So if you're calculating an equity value, you use the cost of equity, but if you use an enterprise value, you use a WACC. It's not a WACC bend over, I'll smack your bum. It's a weighted average cost of capital. So DCF, as I said, the components are your free cash flows and your discount rate. It's often difficult to calculate those free cash flows. We're doing an example at the moment of a mine which has got uranium and on the nose, as everyone knows, excuse the pun. Commodity prices are very hard to predict, and depends on which country you're operating your uranium mine. In Australia, it's really got a huge political risk, but if you go to Africa or Canada or some of these other countries where they have got nuclear power stations, it's quite okay to have uranium mines because the government support them. But the uranium price has fallen through the floor, and a lot of these uranium mines have hit the wall, and really, in order to keep operating, they need a huge amount of backing. So coming up with the future cash flows, you can see is quite problematic. What I mean by terminal value is assuming, so if you had a startup business, you have to give it a go in terms of working out what your predicted cash flows are, but you would expect the business to continue on a going concern. But when you've got a mine, the mine has really got 25 years, and likewise, your toll road only has a finite life. So the terminal value represents the business's value into perpetuity. So this is enterprise value. This is coming down to enterprise value. So if I start with EBIT or EBITDA, which is before interest, and the interest is the component that you subsidise or you pay your debt providers in terms of the charge for the debt. If you had net profit, then you would come down to free cash flow to equity, because you have to pay your debt providers before you take anything left over for the equity providers. So this is free cash flow to the firm, EBIT less your tax, and the tax is calculated on EBIT before interest to get your net profit after tax, but it's a notional net profit after tax because it doesn't equal the net profit after tax in your profit and loss because it excludes the interest component. Then you deduct depreciation because that is not a non-cash item. You add your depreciation, you deduct your capex, and then you less your increase in working capital, and that is the funding of your business. You're hoping your business is growing, so you have to increase as your net working capital increases. You have to fund it somehow. So you have to do that calculation. And there's various ways to calculate it, shortcuts as well as long cuts and proper ways to do it. But yeah, the more accurate you want your DCF or your valuation, the more into the detail you have to go. As I said, the discount rate, the weighted average cost of capital, first of all, you've got to calculate the cost of debt. And generally, we have a look at other comparable debt out there. So you can either use the PPB or some other corporate bond, or you can go to the bank to see what sort of rate the bank would provide you or for that type of business. And then you have to calculate the cost of equity. That is a lot more complicated because the CAPM formula is the beta, the risk-free rate, and the market risk premium. And there's a lot of science that goes behind, a lot of research that goes behind calculating the cost of equity. So this is where the science come into the valuation, really calculating the discount rate. There are a few aspects of the discount rate which requires judgment in terms of looking at rounding the numbers, or if you've got two divergent benchmarks from comparable companies or from the market, you've got to make a call which one you go with, or do you go for a mean, median, and the like. So cost of equity, if you're an equity provider, the higher the risk, the higher return. So if you look at Commonwealth government bonds, they're right at the bottom. They're riskless. You hope so in some countries. Right up to private equity, which is a very risky investment, and generally venture capitalists at the top end of the range are expecting about 80% return. I've got 40% plus there, but I've seen as high as 80% if you work it backwards. So they are the real vultures out there. In terms of cost of debt, as I said, look at market yields. Be careful, make sure your cost of debt is after tax, because the cost of equity is after tax. And remember, your EBIT we've calculated, or your free cash flows, is an after tax. So the rates that you see of the government bonds and the rate that the bank will give you is a pre-tax, so you have to convert that to post-tax. So there's the formula for the WACC, and the cost of equity is weighted by the amount of equity to the enterprise value, and the cost of debt is weighted to the debt to the enterprise value. So that's the D plus the E. The capitalisation of earnings, This is a lot less complicated and generally useful for a trading business that we see every day all around us. It's actually the shortcut for the DCF, where you've got 1 year's worth of earnings, and this requires a lot more judgment in working out and estimating what that maintainable earnings will be. In a seasonal business, that is complicated. In a growing business, that is also complicated. And it takes quite a bit more judgment than a discounted cash flow. You're probably going to argue with me, oh, well, it takes a lot of judgment putting the cash flows together. Whichever way you look at it, the more factors and the more facts you have behind whichever method you use, the better the outcome. So as I say, garbage in, garbage out. So it is important to take the time to make sure that the inputs you use in your valuation, whether it's the multiple or the cash flows or the maintainable earnings, you take the time to make sure that is as accurate as possible. Again, depending on which multiple you use, if you use a PE, price to earnings multiple, that will give you an equity value, but if you use an EBIT or an EBITDA, as I told you before, that is before interest, that will give you an enterprise value. So just make sure you apply an EBIT multiple to EBIT, or an EBITDA multiple to EBITDA. You can't apply an EBIT multiple to an after-tax profit, because then you're mixing bananas with oranges and you get a fruit salad. Some important concepts, as I mentioned, just be careful, match the right earnings with the right multiple and know exactly what you're valuing. Another area where we critique quite a few valuations which are subject to review by the ATO, and you'll be astounded at some of the elementary errors that we see even from sophisticated valuers. So there's the formula for the CFME, the capitalisation of future maintainable earnings. Can we see how we get from the net assets, the net debt, the FME and the multiple to get to the enterprise value? That is your earnings, the FME multiplied by your multiple, give you the 400,000 times the 5 to give you the 2 million. So that's your enterprise value, represents the debt and the equity. Deduct the debt, which is 500,000, to give you 1.5, which is your equity value. It's pretty straightforward. Not always that straightforward in practice. So the cost approach, as I mentioned, gives you the minimum value. It is based on the sum of the net asset values, or the net asset values of your business. So there's no room for goodwill in this methodology, and generally you apply this for businesses that are making losses, that are either hold trading shares as trading stock, or property rich, or some kind of other asset rich company where you wouldn't expect any goodwill, or a business that is hitting the wall. And sometimes you find that even the net asset value has to be impaired if you've had write-ups in terms of the value of your plant equipment or your property. You have to impair that and make sure that your net asset value is actually your market value. And again, have to find a cross-check, which is not always possible when you do the cost approach. So minority interest is another level of complexity. So in terms of valuing a company as a whole, all the valuation methodologies I've explained to you up until now are based on the assumption of control. So control means having control of the cash flows. So if you use all the cash flows in your discounted cash flow, or you use the whole of your EBIT or your EBITDA in your capitalisation of future maintainable earnings, and you use all of your assets from your balance sheet in your net asset valuation methodology, that implies a control value. If you hold a stake of less than 100%, you generally have to apply a minority interest discount. So the smaller the parcel of shares that you're valuing, the higher the minority interest discount. And that really reflects the level of control or the level of influence you have over those cash flows. This is a quagmire and often an area of big debate between valuers. Generally, how we come up with what a typical control premium is, and this is a really strange way of going about it, it's a bit of arse about face here. How we look at what the trends are in terms of control premiums is having a look at transactions out there which of listed companies, and seeing what the differential is between their market cap. So the market cap is made up of all the shares in the company multiplied by the share price, and the share price of a company on the stock exchange is really a reflective of a minority interest discount for the mums and pups or trading on those shares. And if you have a look at the differential between that market cap and the transaction, there is a premium, generally a premium. The difficulty is to try and split out what, as I said, is the special value. So what is synergistic value? If a buyer of this company is in the same line of business, it will probably pay more for that business than an industrial or an investor that is just probably waiting around and just investing in various properties and various companies that they can't get any synergies. So if it was a bread manufacturer buying another bread manufacturer, they can incorporate synergies. So the difficulty is pulling out that special value. But if you do it across quite a few transactions, you can quite see, and you do a bell curve and do all sorts of fancy maths, you can find out and calculate what the general control premium is of that band of companies. And it's interesting over time, depending on what the sentiment in the stock market or the finance industry, the control premiums can go up and down, and depending on the industry as well. Liquidity discounts. Again, we had a professor come and talk to us from Macquarie University, and he was anti-liquidity discounts, saying that a private company is just as valuable as a listed company. So the jury's out in terms, there's varying debates on whether liquidity discounts apply or not. Generally, I'll just go into the theory of a liquidity discount, and that is generally that it's harder to sell a share in a private company than it is in a public company. But on the flip side, selling a big parcel of shares or a whole public company is also expensive and time-consuming. So if you think of an IPO, that takes about good 18 months to 2 years to get off the ground, and the cost of doing an IPO. If you think of a takeover and shareholder approval and all that time and all that cost, legal costs, accounting costs, that's also expensive. So yeah, roll the dice on that one. When we do valuations, there's generally a minimum amount of information we require. And I put that up there because I often get a call from time to time saying, hey, can you give me a quote for a valuation? Finger in the air. Well, how big is the business? How profitable it is? Can you just give me some basic financial information? And I'll generally say I'd like the last 1 or 2 years worth of historical financial statements. I'd like the budget. I'd like the business plan. Generally, if it's a listed company, some brokers' reports, and if there's any previous valuations, just to see what's happening. But obviously, when you start getting into the nitty-gritty, you'll probably need a whole lot more than that to do proper due diligence inquiry into the earnings, and as I said earlier, investigating how those earnings are built up and what's incorporated in the company's profits are very, very important in coming up with a valuation. So common problems. And we see these from time to time, and maybe if I put stars behind all of them, how often I see them coming up, it's quite staggering. So understand what is being valued. Is it the business? Is it the equity? Is it the debt? What is it? Identify the purpose of the valuation. The purpose is very important because the purpose has to be, if you don't have a purpose, then the business valuation can have an infinite life. Like if you do a valuation in 1973, it could be still valid today. So if you say that the valuation was done just for that transaction, you want to save your bum and not get sued. So that's why it's very important when you do a valuation, always put the purpose. Clarify the date of the valuation. As I said, the date from a tax perspective is very important. If you pick the wrong date, then the ATO will question it. Recognise any unusual, abnormal variations in your earnings and justify that. And that takes time and conversations with management to really understand the business. I always going back into your uni books and saying, okay, well, when you do evaluation, remember the Porter's 5 forces, your customers, your suppliers, your employees, and the stakeholders. You need to look at all 4 of those when you're doing evaluation to fully understand what you're valuing and what the key drivers are of the business and hence the value. It's so often easy to do a desktop with blinkers on and just do the valuation based on a net profit or on a profit and loss that's in front of you. But you miss half the story if you don't go out and have a good look at what you're valuing. Use appropriate comparables. Often it's difficult to use comparable companies. We find this, as valuers, we're getting more and more involved in the transfer pricing. Transfer pricing has often been, or in the past, been the realm of tax advisors. And now the ATO has got a package, Capital IQ, I'm not sure if they're out there, have got a special tool to help identify comparable companies, especially for transfer pricing. And we've often seen comparable company or benchmarking analysis done by tax advisors, and they just go to Bloomberg or something and say, all iron producers say. But then you get conglomerates in there and with different margins, and they're not appropriate. Come to us as valuers, and we take a long time trying to find comparable companies in jurisdictions that you wouldn't imagine, and using the Porter-Farr forces is important in thinking about the risks of that business. You might have to think a bit outside the square in terms of your company and find comparable companies. So, for example, we were valuing a quantity surveying business. So we had a look at landscape businesses and any other businesses that were similar to a quantity surveyor, subject to the same sort of risks, had the same sort of customers and same sort of buyers, and use those as comparable companies, just as long as you justify and look at the margins and look at all the different aspects about those companies to see if they're truly comparable. Just for related party transactions. Related party transactions are often not at arm's length, and as I mentioned earlier, beware of arm's length transactions. Sorry, I said skipped correct. Calculate the correct discount rate or multiple. As I mentioned, use the right multiple against the right earnings, the right discount rate against the right cash flows. Identify any surplus assets. Again, tripped up that surplus assets are often taken at book value. Even excess cash on the balance sheet can be classified as a surplus asset. So just be aware of that. So a surplus asset is any asset that is not required to run the business. So if the company's got surplus cash or surplus stock or surplus capacity in the factory, equipment that is sitting idle, that can often be classified as surplus assets, and that goes to the owners of the business or the equity providers, not the debt providers. So any value of that goes to the residual of the equity providers. So that's why you add the surplus assets before you get to the equity value. Inadequate or incomplete financial data. As I said, have a good look around, take the blinkers off, use Porter-Farr forces, look at the industry, look at comparable companies. Then you'll quite easily see whether you're missing something or not. And then valuation conclusions not supported by the report. Make sure that everything in the report sings the same song, that the industry section, that the company overview section, that even the definition of value is the same from beginning to end. I'll just touch on a few quick areas of where tax and valuations collide. Capital gains tax, this is a gem. We often get valuations of businesses which are just taking off, and we work quite close to some tax advisors, and just before it takes off, they want to take the IP of the startup and put it into an operating company. At that time, just before it commercialises, is the right time to do the valuation to minimise your capital gains tax and set a tax cost base for the business going forward. That's at the time when you're getting additional investors in and the business is ripe to going forward. You don't want to leave that too late, because otherwise you'll have capital gains calculated on a zero, or you won't have a cost base. And then you've got all sorts of explaining to do to the ATO. Be careful of pre-CGT assets. That's also a trip up. So this is where I urge all accountants and tax advisors have a good understanding of your clients, and this is where you can really, really help them minimise their tax. So this is an example of a pharmacy that was sold for 9 million, and similar locations had a sale price of about 4 million. So as I said, satisfying this is the small company concession. The 6 million is important, and this is where you can save your company, your clients, a lot of money if you are watching out on the growth of your business and being proactive, trying to keep under the 6 million in order to save CGT. We can help you a little bit after the fact, but it's always problematic. So what would you determine the market value? As I said, the ATO would always lean towards the sale price, but there's always means of coming up with the market value. There's always an answer out there, we just got to find it. Lots of cases around market value and CGT. As I said, if you leave it up to the ATO will always lean towards the sale price. Some more examples about, I won't go into these, you've got them in your pack, just conscious of time. So GST, all valuations are ex-GST, just remember that. All valuations are done exclusive of GST. Income tax, far and wide, it's like rain. Everywhere you look in the realm of income tax, evaluation is required one way or the other. So value shifting, transfer pricing, non-cash benefits, employee share schemes, dividend access shares, property development, as I mentioned, in terms of when does the property development move from a capital asset to an income tax or revenue asset. This is the example I mentioned to you a little bit earlier about the property developer or the taxpayer that had a property, a pre-CGT asset. Your advice as a tax advisor, if you talk to the valuers, just keep it as a pre-CGT asset as long as possible and use that as your cost base. Don't do any structuring. And so often we find that tax accountants don't see the full picture, or accountants don't see the full picture, advise on a restructure, and then the companies, your clients, up for a whole lot of tax. So deemed cash cost or market value. So tax consolidation. Tax consolidation is a beauty, it's a sleeper. This is an opportunity where you have a transaction of companies 100% owned in Australia, where you have an opportunity to get uplift in the tax value of tax deductible assets such as plant equipment, such as trading stock, such as patents and copyright. And this is a once-off and very worthwhile. Generally the fees of the tax advisor and the valuer are paid for by the tax uplift or the tax deduction that the client is able to get. So for those who are not familiar with tax consolidation is where the taxpayer can elect to form a tax consolidated group where they have one tax return. Often small practitioners don't look at this and think it's only for the big end of town, but even if you've got clients with a complicated structure and you've got thousands of tax returns, it's often worthwhile having a look at a tax consolidation. As I said, there's quite a bit of tax uplift, and some of those assets that you should pay attention to is the property, plant equipment, trading stock, and some intangibles, copyrights, software and patents. You can even identify assets that are not on the balance sheet from accounting perspective, so the internally generated assets like software, if the company's built the software, or there's patents, or there's copyright. Impairment, as I mentioned in the pharmaceutical company, just be aware of this. There's a safe harbour and the accounting standard 136. As I said, the ATO is looking far and wide in terms of its evidence on taxpayers and looking closely at the accounting standards. And even when you read the ATO guidelines, you can see there's so many references to the accounting standards in there, it's unbelievable. Employee share schemes, we often get called in to do valuations just to come up with a value of a share that is worth nothing, so that there's minimum tax from the employee perspective. We often have to do a valuation of the business if it's a private company to come up with a value of the share, and then we value the option or the performance right using a binomial or a Black-Scholes model. You try to get it just above zero in order to minimise the tax. And that takes quite a bit of work in terms of also explaining to the employee. There's nothing more disheartening in saying to the employee that you've got these beautiful options that are worth nothing. But we just say, egos aside, this is just for tax purposes. And this is again why it's important to make sure the purpose of your asset, purpose of your valuation is in your valuation report, just to make sure it's not construed for the wrong purposes. Thin capitalisation, as I mentioned earlier, this is again the pharmaceutical company which breached the thin cap rules when they started impairing some of the intangible assets when they weren't travelling that well. I've not been a tax practitioner, but if for those tax practitioners out there, you understand the difference between the safe harbour and the other elected approach in calculating the thin cap. Again, for thin cap, you can use the value of intangibles that are not on your balance sheet in order to come up with a formula. And that's important. We were looking at a global mining company, and they had some thin cap which they were looking, again, being proactive. The accountants saw they were starting to travel south, so how could they shore up their formula for the thin cap? And we were able to value some intangibles to keep the formula intact so they wouldn't breach the thin cap rules. As I said, internally generated assets can be valued for various aspects of tax. That's legal advice that we've just recently received and is often overlooked, so keep that in your back pockets. ATO market value rulings. Again, the ATO has got prescribed systems and processes in order to get a tax ruling. The ATO is now open to working with the taxpayer in coming up with a tax ruling. We're working with a company at the moment with their valuer where they are doing a restructure, and we have to value some of their customer contracts, and the tax ruling is on foot. So we're doing it concurrent, we're doing our valuation for the ATO, we're on the ATO side working with the taxpayer's valuer in order to shore up and work out what should be in the tax ruling. It's quite an unusual situation here, because often what we find is that the valuations are done, or the tax rulings are done way after the event, and sometimes not the best outcome for the client. But the go live button will be as soon as the ATO says, yes, okay, the tax ruling's fine, and then the company can proceed with the restructure. So everything is coterminous. So some tips and tricks. Briefing the valuer. Again, this can be very beneficial, or it can be not so good. So as I always say, pay peanuts, you get monkeys. Garbage in, garbage out. So if you've got a client that you're advising to get a valuation, just be alongside them, or even take the reins and advise the valuer appropriately. Make sure that the valuer is independent. That's one of the first things the ATO has a look at in any submissions of valuations or any tax lodgements that are supported by a valuation. The ATO has got a panel of valuers, so pick a valuer that is on the panel, and we can say PPB is on the panel. The ATO is quite used to seeing us on both sides, and pick a valuer that is respected by the ATO. If the ATO doesn't like your valuer, they'll go and appoint their own, and your client will be up for 2 lots of fees, their own valuer as well as the ATO's valuer. As I said, make sure the valuer is independent, so your instructions should be quite concise and precise, and full of complete. If you leave out any detail in your instructions, that will be open to interpretation of the valuer, and there might not be an audit trail if they start leading in the wrong direction and the ATO gets suspicious. Engage with the ATO early. Make sure you talk to the ATO and let them know what is happening. They won't always give you the answers, but if something is complicated, they often are open to listening to what you've got to say, and will be more open when the lodgement is made. Sometimes get 2 valuers if the issue is complicated, but again, that also raises problems if you get one valuer says it's worth 100 million, another one says it's 50 million. Pulls apart, what do? Do you get a third one, then you're up for 3 lots of fees, and what if they come up with 150 million? Maybe going with one good valuer once up is the best way to go. Manage the valuation dispute. So if there is a dispute, try and respond to that early and be proactive, and don't leave it with your client. Your client will probably be emotionally involved, and things can go pear-shaped. And just make sure that you use the ATO guidelines when you're instructing the valuer, so that when you get the valuation report, you can do a check against the risk matrix to make sure that it is complete and correct, and everything is included, so that the ATO is happy with what you provide. The ATO market valuation process. So the ATO's consideration when they decide whether a valuation is high risk is really looking at the assets that are valued, or the transaction. If it's high risk, if there's lots of dollars involved, they are more cautious in terms of the assets involved. If it's intangibles, again, they're more cautious. Materiality and the potential adjustment. So anything that affects the amount of tax, they pay particular attention to. I'm hearing that the ATO is also having a look at small businesses. So again, they might be looking at smaller dollars. Really depends on how empty their coffers are as to how low down the food chain they actually go. The ATO panel of valuers, so that is on the website, so you can quite easily see which valuers you should be using, and the specialist ATO valuation gatekeeper. So they've got their own internal valuers, but generally the turnover of the staff at the ATO is pretty high. And we've often found that when we get involved in complicated matters, we have to give them 2 or 3 hours of valuations 101, as we call it, to get them up to speed as to what they're talking about. So they're quite quick to come up to us if they're out of their depth. So you just be aware that the ATO generally doesn't have the resources in order to assess the lodgement or your case by themselves, and they will generally have to appoint a valuer, so that is more cost to your client. So some concluding comments. Valuation is a craft rather than a science, I'd say. There's a lot of areas where are grey, and yes, I will remain as an independent valuer, but the grey bounds is as wide as a toll road, I suppose. So we will always go out to help our taxpayers the best we can, and that's a very rewarding job that we have got, to see how we can save our clients quite a bit of money. The devil is in the detail, so the more you know about your client, and if they're your client and you see them on a daily basis, you'll know them really well, and if you can impart that knowledge onto the valuer, that's all well and good. Select the appropriate valuation methodology is key, and always do a cross-check. Know what you are valuing is always very important. The enterprise value, equity value, with some kind of intangible. It's important to clearly define the role at the outset. So what is your role, what's the valuer's role, and what's your client's role? Work with the tax advisor. So if you're an accountant, work with your tax advisor and work with the valuer. Follow up there on the ATO's guidelines. Have a look at the ATO guidelines and make sure you follow them, and make sure your valuer follows them. And the accounting standards are always a good start. Don't forget them just if you're looking at tax. And as I always say, documentation. Even if you make the wrong decision, make sure you document why you made that decision. And even if it's wrong, the ATO is a bit more lenient if you've thought about it, rather than hazard a guess or swept it under the carpet or didn't have a response.